Hey everyone, and welcome back to Am I Catching a Falling Knife? The show where we dive deep into stocks that are taking a serious beating. Today, we're looking at DexCom, ticker DXCM, which has seen a pretty dramatic sell-off recently. Is this a golden opportunity, or are we looking at a genuine knife edge? Let's find out. The core narrative surrounding Dexcom's recent struggles is multifaceted. We've got a significant guidance reduction directly linked to weaker execution. This means salesforce reorganization woes, fewer new customer additions than hoped, and a faster-than-expected drop in revenue per customer due to things like rebate eligibility and channel mix. On top of that, there's regulatory pressure. They've received an FDA warning letter concerning manufacturing processes and quality systems, raising questions about potential delays for future products, like the 15-day G7 sensor. Competition is also heating up, with Abbott Laboratories being a major rival, and some analysts believe Abbott's devices might be more attractive to customers. Historically, Dexcom has also seen delays in product launches, such as the G7, due to software and FDA clearance. Add to this a looming CEO transition in early 2026, and you have a recipe for investor unease. First off, let's get a handle on who Dexcom is. They're a medical device company focused on designing, developing, and commercializing continuous glucose monitoring, or CGM. Think folks with diabetes using their tech to manage their condition. Their product lineup includes the Dexcom G6, the real-time API for developers, Dexcom One to replace finger sticks, and the Dexcom Share for remote monitoring. They've also got the next-gen G7 in their sights and a partnership with Verily. They market directly to doctors and diabetes educators. Dexcom is a big player with a market cap of nearly $30 billion, trading on the NDX and S&P 500. Right now, the stock is sitting at $75.96, down a hefty 7.66% just today on significant volume, over 6.4 million shares. Now, when we look at revenue, Dexcom is heavily concentrated in the United States, bringing in $2.63 billion from the US, with another $997 million coming from international markets. Digging into the financial metrics, their PE is around 53, with forward PE at 29, suggesting analysts expect earnings growth. EPS trailing 12 months is $1.43, and they expect EPS next year to jump 25.59%. Sales were $4.30 billion, and sales are growing year over year at 9.30%. They've got solid margins, with a gross margin of almost 59% and operating margin of nearly 16%. However, their EPS year over year is down by almost 15%, which is a key concern. Let's crunch some numbers. Using a discounted cash flow model with a starting EPS of $1.43 and projecting a 24.60% EPS growth for the next 5 years, a 9.5% discount rate, and a 2.5% terminal growth rate, we arrive at a base case fair value of $50.70 per share. Now, how does the market narrative impact this? The narrative points to significant headwinds: the guidance cut, regulatory concerns, increased competition, and leadership uncertainty. These factors logically suggest a reduction in future revenue and earnings potential. To account for this, we'll apply a conservative 15% reduction to our projected future EPS and terminal value. This adjustment brings our narrative-assisted fair value down to $43.10 per share. Based on this analysis, we can look at a few potential buy levels for consideration. Level 1 would be around $50, Level 2 at $42, and a more aggressive Level 3 at $25. So, there you have it, Dexcom. Remember, this is not financial advice. You absolutely must do your own thorough research before making any investment decisions. Thanks for tuning in to Am I Catching a Falling Knife? We'll see you next time.